have the first stick in the green. So let's just wait by for the opening rate. Heavyweights like Titan continue to bat for the Bulls. There we have it, 65 points in the green for the Nifty, holding on to 19,580, turning out to be a good start. The first stick on the index is a positive one, 72 points higher now. The mid-cap index is up 220 points, and the advance decline ratio is well in favor of the advances at 1,860. The Bank Nifty is also up about 200 odd points. What's leading from the front this morning? Adani Ports on the back of that CLSA report, as we were mentioning. ONGC has been moving with some strength because of the move in crude. Bajaj Finance, Hero MotoCorp, M&M, Tata Motors, all the auto stocks are up and about this morning. Bajaj Finserv, Adani Enterprises, Hindalco, a couple of other stocks in the green. There are barely any stocks in the red, actually. Dr. Reddy's, Britannia, TCS, just 3 stocks that are marginally in the red. That too just about in flat terrain. Otherwise, it's a good opening for the market. The advance decline ratio is now well in favor of the advances, and the Nifty is powering through to that 19,600 mark. Better opening for the mid-cap index.
Well, absolutely, Sonia, and plenty of stocks are moving around. Moscow and Dock, they've signed an LOI with a European client for multi-purpose hybrid power vessels. That stock is flying away. Genius Power, they won that 3,115 crore smart prepaid meters. So that stock as well has bounced up close to around 5%. Remember, it corrected nearly around 10% from the recent peak. Now it's pulling back. GR Infra, the Mang Power JV executed an agreement worth around 3,600 crores with NHPC. So that stock as well is up close to around 2%. SEPC, well, that's another stock that's coming on my radar. That's moving up. That for the second day running on rather large volumes. Just thought we'll highlight that. Dilip Bilkon on the back of that order win. So that stock as well continues to move higher as we speak. And a few names then, that are doing well from the frontline stocks. Escorts Kubota, that Sonia just mentioned, 3.5% higher. Union Bank is bouncing back today. Oil India continues to do well, building on yesterday's gains. And NMBC as well as higher with a gain of around 1.5%. Lloyds Metals, I haven't had a look at that, but you had a Queris note that had initiated coverage. They've stated various points that they believe that the stock is well placed from here on with regard to pricing as well as production. So Lloyds Metals should come up for you. The target price that Queris has given is around 600 rupees. That was 9% away from yesterday's close price. So let's get that up as well for our viewers.
Well, it's a good start, isn't it? By the way, as we were talking about it in the morning, we open exactly into that 19,605 level, which is the nothing but the 40-day exponential moving average, which is the resistance. I mean, on the way down, actually on the way up, that is acted as a fair sort of nice support for a long time before it broke. As we try to come up again, I think we'll have to see if that is taken out with ease. But you're opening, we open about 10-15 points short of that level. And I think the day's high is exactly that. So around 19,600 is where the Nifty is at. Now, a few other names. You've got, I think, Mazgaon, Nigel mentioned Cochin Shipyard as well, 3.5 higher. Escorts is coming up. Shipping Corporation is another one, 5.5% on Shipping Corporation, 152, large volumes. Garden Reach, of course, we put out. So these shipbuilders are all doing well. There is Genius Power, which we mentioned, 5%, limit up. So nothing very much else if you want to just find stuff with decent-sized volumes, maybe more into the mix a little later as we kind of continue to trade. But for now, on the upside, there's not very much else which is coming through. On the downside, maybe Suzlon, perhaps we can highlight. It's down 3.5%. So almost got to 30-ish kind of levels, but it's now back on just under 27. And look at Triveni Turbines, which is down about 3% or so as well. And that is down a little bit. So yeah, those are the two names I can spot which have got volumes and which are down 3.5%.
Just one more stock I want to point out, which a viewer actually has brought to my notice. That is Aventil. It's a small company that in the last few years has gone up big time. They came out with their numbers. And in fact, it looks very, very good. So just had a brief look out there. They're doing only 54 crores, but Aventil, it's a BSE listed company, 2,500 crores market capitalization. We're talking about it because it's actually at upper circuit and volumes are very, very high. So the numbers for the last quarter look very, very good. AVANTAL. I think we should get that up. Margins are the highest that I've seen in very, very long time. And in fact, just looking at it, a few years ago, they were doing 50 crores of revenue in a year. Now, in a quarter, they're doing it. They're part of that ships, submarines, etc. And it was, it's being built by this entrepreneur. His name is Mr. Vidyasagar. He's an IITian. And I recall 5 years ago, I asked him, I said, sir, but you're selling in the open market. He said, this is my only business. And I don't think it's anything wrong. So I said, from the share market perspective, they don't like it
They've
at all.
got it up.
Yeah, so that's the one they were talking about. And the only reason we're highlighting it is because it's up close to 20%. Came out with its set of numbers. The market capitalization moved from around 200 crores to 2,500 crores in the last 5 years or so. In fact, I'd forgotten that we had covered this as well a long time ago. But, have covered many, many stocks and just educated the viewers about certain stocks in the last few years. So this is one of them. Just thought we'll highlight
So it's up from 2020, July of 2021. It was 27 rupees. So yeah, it's basically in 2 years, it's up 10 times. So it's incredible. Absolutely.
Yeah, but there's no institution holding out here. Yeah. So, you need to put everything on board, though the operating cash flows for the first half of the year have improved.
All right. Well, so that's an interesting name, which we don't talk about. Actually, we've not talked about at all.
Ever
in the past. I think, 88 points higher is what we have on the Nifty, and things are coming together, nicely. So far, so good. Maybe we can pull up Zomato as well. Zomato is up about 3%, and we're seeing some delivery partners of Swiggy, at least here in Mumbai, on strike, etc. We've heard reports and such. But Zomato is up about 3%. That's a direct competitor. What else? Kalyan Jewellers, perhaps it was not there in the mix. We didn't mention it. 5.5% once again on Kalyan Jewellers. It's at about 266. That's also a doubler this year. We've got what else? I think Zaggle is another one, which is a recent listing, 3%. Zaggle has done well over the last few trading sessions or so. So more in a bit from now. Ashwini Agarwal is founder and partner at Demeter Advisors. He's joining us with his thoughts and perspective. Ashwini, good to have you with us here on the program. Thanks as always. Let's just start with banks and financials, Ashwini. After the last RBI policy, which was in a way as expected, but in a way unexpected as well, because the RBI said they're going to, do large-scale sale of government paper. Of course, timelines, etc., are not disclosed as of yet. That led to bond yields jumping higher quite a bit. What's the outlook for banks, both PSU and private, from here?
So, Prashant, what we are seeing on interest rates is, quite worrying from a global perspective. I mean, we've seen what's happened to U.S. government bond yields. And in the light of where U.S. 10-year government bond yields are trading, Indian government bond yields of a similar tenure are on the lower side. To my mind, there should be a 3 percentage point difference between the two, which is slightly narrower at this point. So my sense is that the yield increase at the long end of the bond curve is not just an Indian phenomena, it's a global phenomena, supported by the fact that inflation continues to run higher than what most central banks would like to see it at. What does it mean for the banks? I think, my sense is that if you just look at the loans growth data that's been posted by the RBI, 17-18%, deposit growth of 11-12%, a shift away from CASA and higher bond yields. You put all of this together, and my sense is that while spreads will compress a little, there is enough operating leverage that you get from a 18% loan growth that you might be able to maintain your pre-provision operating profit rate for most of the banks. That's the sense I have. Below that line, you're continuing to see very benign credit costs. So I think from an earnings perspective, there is no need to worry for the banks just yet. However, having said that, if you want to look out 18 months from now, I think the rising unsecured loans is something that can create a problem if the economy were to slow down significantly. And the reason I say that is that while economic growth domestically is being driven by government capex, the export outlook continues to be fairly subdued. And we don't know what happens to the energy prices given the crisis that we are seeing in the Middle East at this present point. So, My hope would be that no new stress emerges over the next 18 months or so. But for the now, I would say that there is no significant earnings pressure.
Okay, by the way, there are a lot of stocks that are in focus this morning. Kalyan Jewellers, by the way, has hit a record high. So just keep an eye out on that stock, 6.5% higher now. And this year, Kalyan Jewellers has more than doubled. There's also big buying that you're seeing in real estate stocks. All of them are up about 1 to 3 odd percent. Keystone Realtors reported their numbers as well. All of them, you know, even the smaller guys like, say, Ajmera Realty, Mahindra Life Spaces, the bigger guys like Soba, Prestige are all in the green right now. Godrej Properties, DLF, all up about 1 to 2 odd percent. Ashwini, good morning and thanks for joining in. Since we're talking about real estate, I wanted your thoughts there because, you know, there is some hyperactivity happening in this space now in terms of, you know, new projects coming on board, the sales that are happening across metros, right? Not just in Mumbai and Bengaluru, but even in places like Hyderabad. From an investor standpoint, is this a start of a multi-year upcycle, and would you advise buying into real estate stocks?
Morning, Sonia. You know, the way I think about it is that real estate and stock markets are joint at the hip. And every stock market rally with a lag leads to a real estate demand pickup. Add to that the fact that real estate prices went nowhere for almost a decade between 2010 and 2021. And that brought in the affordability of real estate within the grasp of a lot of people that had probably stayed out of the market. In addition to that, you've had a huge amount of wealth creation via the stock market, via ESOPs, via startups, and that's all starting to feed into the real estate economy. You also spoke about Kalyan Jewellers, something I don't own, but you know, the connection I'm trying to make here is that we are also seeing a continuation of the K-shaped recovery that we used to speak about during the COVID and in the immediate aftermath of the COVID. And so the rich or the well-to-do have a very solid potential to consume. You are seeing that in jewelry. You are seeing that in the Titan numbers that were reported for the month of September, quarter of September. And again, I have no position there. You're seeing that in real estate sales. You're seeing that in luxury cars. But at the same time, the not so well off India, and when you look at consumer staples, you look at demand for coming from rural areas, that's not very exciting. And I think, and this is a trend which is similar to what we are seeing pretty much everywhere in the world. It's not a great commentary because I would like the wealth effect to be more broad-based and to hope to see the trickle-down effect happen over a period of time. But it is what it is. From an investing perspective, I've always found it very tough to invest in real estate companies. There are event risks that I'm unable to forecast. So I like to play real estate, if at all, via proxies, whether it's plywood or tiles or fittings or, possibly construction materials in wood or cement or whatever have you. Directly buying real estate companies is always fraught with some amount of project-related risk, which I like to personally steer away from.
All right. Hi, Ashwini. Good morning. The last time we chatted, everything was looking up, but you told us that we're lacking triggers to go to 21,500, 21,000 odd. And it appears there are plenty of headwinds that have turned up since then. Whether you're talking about the Fed speak, the move in crude, the dollar index, and now, unfortunately, this Israel war that's breaking out. Do you think the ingredients are in place for us to see a sharper correction from these levels? Because give and take everything, we're still only 3% away from the recent highs.
Najil, what you said is absolutely right. I think, there are all the elements in place for a sharper correction to happen, but whether it will happen or not totally depends upon the domestic investor sentiment. If you think about it, the flows into the market are quite robust. Mutual fund inflows are reasonably robust. Direct inflows are quite robust. And till the domestic investors are comfortable, till there is no imminent real risk to the domestic investor appetite, I think, a very sharp sell-off is out of the question. Now, can we get a 5%, 10% sell-off? Yes, that's possible. I mean, if the global markets were to become very nervous about what's going on in the Middle East, if that escalation of that conflict goes beyond the localized trouble that we are seeing in Israel at this point in time, Something else can happen given a lot of uncertainties around interest rates and the accidents that may cause, at the rate at which rates have gone up in the Western world. I mean, all these are signs of danger. But till the domestic investor sentiment is intact, I don't see a significant sell-off. It's puzzling because there is just so many uncertainties out there, and the domestic investor is still very, very comfortable. But it is what it is, so we have to deal with it. And I hope there is no domestic event that leads to a massive sell-off. International events we'll have to contend with as they come along.
How are you feeling about the auto sector now? Because, there is this big demand push that's taking place and raw materials have cooled off as well. Markets like the rural markets have come back, and, even companies from the two-wheeler space, which was the most affected, right? They're talking about how there is a recovery in demand. As an investor, how are you feeling about it?
Sonia, obviously feeling a little bit more constructive now looking at the data. But whether this demand revival sustains or it is just a very near-term phenomena for the next 2 or 3 months, given it's the festive season, and you're coming on the back of multiple years of no growth in the two-wheeler area, I'm unable to parse that because the readings that I'm getting on rural demand are very mixed. There are a whole bunch of areas where one continues to see fairly tepid rural demand. So the two-wheeler might be an exception given by a forced renewal cycle after so many years of slow growth, or is it something deeper? I'm not able to make out. On the premium auto side, whether you're talking about mid-size SUVs or small-size SUVs, or you're talking about premium cars, I think there is a lot of traction there. And the urban demand in that area is extremely strong. So, some of the car makers and some of the premium two-wheeler automakers are continuing to see a lot of traction. And that again feeds into the whole, the rich are doing well narrative that I spoke about earlier.
All right. We'll let you go on that note. Ashwini, thanks a lot for joining in.
Thank you.
And have a great day. Thanks for giving us your thoughts on the markets. Well, let's focus on IRB Infra because the company reported a steady September toll collection growth. In fact, Q2 toll collection was up 22%, coming in at 1,200 crores. Also, there is some more, positive updates on the company. They expect a 10 to 15% growth from the EPC business. To discuss this and more, Anil Yadav, who's the Director, Investor Relations and former Group CFO of IRB Infra, joins us now to talk about that. Anil, thanks a lot for joining in. I want to start with the toll collections itself. This time September went up by almost, 30%. You're sitting on a base of about 420 odd crores. What is the average run rate, monthly run rate that you hope to see in toll collections over the next many months?
Thank you. We have witnessed 28% growth in the September month. And if you look at the private InvIT alone, there the growth was close to 35%. And IRB asset, which has Mumbai, Pune and Ahmedabad, Vadodara, there growth was 21%. If we look at Mumbai, Pune alone, there the growth was 25%. And now the festive season is starting in India. On the backdrop of the festive season, the traffic growth should improve from here on.
All right. Hi, Anil. Good morning. So what could you guide us in terms of a number? What could that look like? And also give us a sense about collections.
Yes. With respect to collections, if we'll talk about the September month, Hyderabad ORR has started from the August. And full impact of the Hyderabad ORR will be visible in the Q3 and Q4. And we are about to start Samakhali project. Both Hyderabad and Samakhali will contribute in Q3 and Q4 from here on. So that will be the additional revenue will be coming in. Apart from that, we will see around 15 to 16% growth in terms of the existing assets also. Because Mumbai, Pune had a 17% tariff revision, both corridor put together, and around 7-8% kind of traffic growth on Mumbai, Pune, which we have witnessed in the September also. The overall growth on existing portfolio should be in range of 15 to 16%. Plus, if you add the Hyderabad and new project coming in, the growth momentum should continue in the coming quarter as well.
Okay.
All right. Got that. Then you're expecting growth momentum to continue. But Anil, give us a few more details then. Give us a sense of how the private InvIT activity is panning out. Are you on track for the 2,500, 2,600 crores of revenues, as well as a bit of, I think, 1,500 to 1,600 crores for this fiscal year?
Private InvIT, what you have talked about is only for 2,500 to 2,600 crores is revenue only for the 10 assets which were there at the beginning of FY24. So that includes the first 10 assets. Thereafter, we have added Hyderabad Ovara and Samakhli will get added. So then definitely from 2,500 on annualized basis, there should be another addition of roughly 800-850 crores of revenue on top of that, and EBITDA of around 1,500 to 1,600 crores. Another 700 crores of EBITDA should get added once this project starts contributing. Hyderabad has already started. Samakhli is about to start. So Hyderabad alone itself will provide an EBITDA of roughly 600 to 650 crore rupees.
Okay, Hyderabad will provide an EBITDA of 600 to 650 crores. Got that. I wanted your thoughts on this 18% GST that was, proposed on corporate guarantees for subsidiaries. I wanted to understand for infrastructure players like yourself, what could the implications or impact of this be?
I think with respect to this corporate guarantee, whatever provided, overall, it will not have any major impact because anyway, IRB does the EPC and there is a cash outgo every month on account of GST. If the SPV, if we will charge to the SPV, we'll get an input credit for the same. And secondly, anyway, today you are charging for the EPC. So to that tune, EPC can reduce by 1% and that you can charge by way of corporate guarantee. I don't think so. It will have major impact for players like IRB, which has integrated approach that we do a construction for subsidiaries as well and also provide the corporate guarantee for the same.
Okay, and for this, the InvIT holders, right, the publicly listed InvIT holders, is there any plan for any kind of dividend payout? Because now you have sort of reduced your debt is paid off as well. So will the payouts increase for InvIT holders?
As of now, we are guiding around 8 rupees per annum payout. And as and when the payout will improve, definitely we will share those data. But as of now, we are guiding only for 8 rupees payout per annum.
All right, Anil, what about raw material prices? I track cement very, very closely. And the sense is that, prices are expected to go up from here. That could be a bit of an issue for you, right? How do you see things panning out? Because cement prices holding strong. The hope though is that we're getting to a general election and there'll be some kind of cap that will put in place. Tell us how you're reading the situation.
I think before going to the EPC side of the business, I would like to add on the private InvIT. We have got a sanction of 6,400 for 5 of the SPV of the private InvIT. And we are there moving the debt from SPV level to the trust level. And there will be a roughly 115 basis point saving on the interest cost and almost 15% saving in the amortization over the period of 5 years. So last year, we have refinanced a couple of projects and saved almost 500 crore cash flow over the period of 500. And for this 5 project, the saving will be almost 3x. And which will be close to 1,500 crores, close to 1,000 crores on account of amortization and roughly close to 500 crores on interest saving. Now, moving to the EPC side, we have a large portion of the EPC which comes from the O&M. So we expect stable revenue from the EPC side and probably the second half revenue should improve. And we also provide the key raw material which is required for the road construction in our corporate presentation, that is cement, steel, and bitumen. And if you track the last 12 to 18 months, we have not seen any major increase in the prices. Prices has either reduced or remained stable where they were up before 12 months or 18 months. Probably because of the prices remaining at the same level, probably we'll see a 100 to 200 basis point improvement in the construction market.
Just one final question, is there any kind of political pressure that one can expect on toll collectors ahead of the elections? Because there is, so much talk back and forth on making Maharashtra toll-free as well. From a toll collector standpoint, what would the implications be ahead of the elections?
I think we are in this business in the last 3 decades, and we have not seen any closure of the toll plaza. But we have a model concession agreement which provide adequate compensation, which talks about paying out for 150% of the equity invested, adjusted for the inflation in case of such eventuality. So we are well covered as far as concession agreement is concerned. But if you look out, India is looking for the expansion of the road grid. And so far, the project, whatever we have constructed or which are already awarded, roughly 1 lakh kilometer has already constructed or already under construction. Probably as per PM Gati Shakti plan, they are talking about 2 lakh kilometer to be constructed by FY 27 or 28. So then if we want to expand the grid almost equal size what we have done till today, then definitely that will require a private participation. And to attract the private participation in the sector, I think the government so far is doing that. They have never tried to tweak the concession agreement or make the changes after awarding the contract. Whatever the changes has happened with the prospective effect. Considering the such large pipeline, I don't expect that there will be any kind of issue in terms of the toll collection on overall basis.
Okay, all right. We'll leave it there. Anil, good to speak with you. Appreciate you joining in, and it's always a pleasure, having you here. The markets, bumping into 19,600 once again. So there was a bit of a give back, but not very much since. I just want to, before we take a break, highlight a few other names. We were highlighting Kalyan Jewelers, which was up 5%, but it's not just Kalyan, right? You look at something like a Tangamail Jewelers, which is up 5% right now. Volumes are not as strong as, of course, what Kalyan is seeing, but Tangamail is, I think, at a new high, almost at 1,400 rupees. Vaibhav Global, it's a different business model, but that is up about 4% as well. Stocks at about 425 in the imitation jewelry space largely. And then look at Tribhuvan Das Zaveri, which is TBZ. That is up about 5% as well. So this seems to be, a move across the, second tier 2 kind of jewelers. TBZ is up about 4.5%. It's been at least stock price wise, has been a dead name for a few years now. Let's look at Senco Gold as well, which is the latest addition to this list. Predominant in the eastern part of the country. That's done well since listing, and that is also up about 5%. So, this is a theme which is playing out quite nicely. 640 on that one. The other one is power, and we mentioned Genus Power right at the word go. That we had a 5% gain there. But look at KEC. KEC, I think, is up about 4%. Skipper Limited is up about 4%. And you've got a few other names here from the space also, which are not doing all that badly. So keep an eye out on the other sort of theme there, which is power. But the big one, of course, is these smaller jewelers, but not really smaller. Kalyan is not small, but these jewelers doing quite well. We'll take a quick break here. We are back. We shine the spotlight on the insurance space ahead of the second quarter earnings. We'll have Madhukar Ladha, Director of Nuvama Institutional Equities, joining in to talk about expectations in the second quarter from the sector. Stay with us.
Welcome back. Well, the markets are holding with gains of close to around 85 points or thereabouts. Remember, the 50 DMA on the Nifty comes in at around this 19,600 odd. But it's been a good first half hour, actually. The Nifty Bank as well has crawled its way above that 44,000 odd mark. Yesterday, it came in for a hard knock. And the breadth of the market is looking very, very good, with 8 stocks advancing for just 1 stock that's declining. We have with us Mr. Madhukar, who joins us to help us out with a quick analysis on what we expect from the insurance space in the coming quarter. Hi, Madhukar. Good morning, and thanks so much for joining in. Well, tell us the key points that you're going to be tracking, for the coming quarter.
Sure. So, coming quarter, growth has definitely improved in Q2 versus Q1. So that's a positive. But in terms of product mix, I think for the life insurers, the growth is driven more by ULIP, with markets doing well. I think what will be important to see will be, how individual protection is growing and whether non-par products are holding up in the share, given, the interest rates have moved higher for other sort of products as well. So, and finally, on the margins front, I think broadly the street does expect slightly muted margins on a year-over-year basis. So anything, my guess is more than maybe about 200 basis points will be taken as more negative. Yeah, broadly these things would be watched out for in 2Q for the life insurers in particular. Yeah.
Madhukar, hi, good morning. Let's talk about it one by one, right? I want to discuss what's happening with HDFC Life because, it's been a good start to the year for that company. If you look at the numbers, right, the individual AP grew at almost 10%, almost double digit. The total AP went up about 14% and compounded, if you look at it, the individual AP has grown at about 15% in the last 4 years. But this stock is just not doing anything for investors, and it's been a frustrating 3-4 year period where HDFC Life has done nothing. Your thoughts on what the way forward could be?
So I think in relatively probably about 3 years back, I think the growth was a lot stronger, and it was the only sort of dominant player in the HDFC Bank channel. So since then, a lot has changed, and the valuation that the company was getting was a lot higher. Post that, actually, right now, the competitive intensity in the industry is also much higher. Their growth rates have come off. Having said all of this, I think it's still a solid, rock solid company. They're the product innovation leaders in the market. I think the brand inspires a lot of sort of confidence and faith from buyers of their products. So still, I think the company is pretty good. Having said that, I think right now what will be a key monitorable is after it has become a subsidiary of HDFC Bank, how much more support can it get from the bank? I think that's a key monitorable. So, broadly the sense is that the share of what HDFC Bank sells between, Tata, Birla, and HDFC Life share is closer to about 55-57%. And the street expects this to move a lot higher. Let's see, if that plays out, I think the stock could see a re-rating from here. I think that'll be a key monitorable for the stock. Yeah.
But that's still your top pick, Madhukar?
My top pick would be SBI Life. I think.
SBI Life. Okay.
They on a valuation basis, as well as the growth that they're showing and margins that they have, I like SBI Life the most right now.
What about sort of general insurers? The devastation caused by floods in Sikkim and the damage to some of the hydroelectric power projects. Have you looked at? I mean, who's the insurer? Will that cause any damage in the listed space?
sort of, plant-specific details, I don't have that. But broadly, what happens is when these are sort of large plants which are insured, then almost the entire sort of industry is carrying some bit of the risk, and which is again then reinsured, right? So these things do happen, and they do impact the quarter as such. But insurers have cat loss reinsurance, etc. So they get largely sort of reinsurance coverage of there, and it's not that it normally does not work out to be that bad. This quarter for general insurance uh, is expected to be better because what happens is this is a seasonally stronger quarter. A lot of the business gets written in Q1, and the expenses are upfronted in Q1. So this quarter, then the expenses are lower, so your underwriting surplus looks better. So in that sense, Lombard, we are expecting, we are expecting sort of better numbers, yeah.
Okay, okay. Madhukar, one of the things which has not been discussed very much is the the implementation of the new the accounting norms, Ind AS norms, right? Which is comparable to IFRS 17.
Right.
And I think the regulator wants that to be implemented from the 1st of April 2024, which is pretty soon.
Pretty soon, yes.
Have you looked at this in detail? Will this make a big difference? It will change change things in terms of how you account for premium received, how you account for expenses, etc. But briefly, what are your thoughts? Yeah,
I think two big changes. I think, and within that also, I think the biggest change is going to be the deferment of acquisition costs. And once you allow for that, then you really don't need to get into the concepts of VNB, etc. So to that extent, what happens is that the accounting profits are the basis on which you could value most of these companies. And the accounting profits would improve. The ROEs would broadly sort of go up. And my sense is that the life insurers would see ROEs of between 16 to 21% or depending on which company it is. And general insurers, the impact is a little lower because normally the business that they write is just 1 year, so the deferment of acquisition costs is there, but benefit is slightly more muted. It's much more for the life insurers. And over there as well, we'll see some improvement in ROE and profitability. So you could expect about 200 basis points, 200 to 300 basis points sort of improvement in ROEs for the general insurers and health insurers as such.
I just had a thought that I wanted to put forth to you on ICICI Pru, right? iPru has been underperforming its peers for a while. I mean, if you just look at the numbers, the APE growth this time was barely about 4% in the individual APE I'm talking about. Overall APE growth was actually a fall of 1%. Why is this underperformance there, and what is the expectation in Q2?
So, couple of things. It's a well-known fact that ICICI Bank is sort of not selling few and a very large portfolio of products in life insurance, right? So, so a bank partner which used to contribute almost 55% of iPru's APE, 3 years back, is now down to just about 15% odd. So again, a principal bank partner is very important. I mean, life insurance, each of the other listed life insurance companies have a primary bank partner which is contributing significantly to their sales. So I think over the last 3 years, you've seen that rundown happen. So business has declined from that channel, and they've had to sort of develop other channels. So the focus has more been on agency and other banking partners that they've acquired. My sense is large part of the ICICI Bank channel decline is now played out. It will probably stabilize at these levels. And what was disappointing is that the other partners, AP growth was just about 2.5% even in the last month. So while July and August were slightly sort of better growth months for the company, September disappointed a little bit. And lastly, also on the group side, group AP contributes almost to about 18 to 20% of their top line. I think that is a fairly competitive business, especially the group term insurance where iGrew is present. And I think they'll also see some pressure over there, some top line pressure over there. Finally, on the margins, I think margins are also coming off for them. There were tailwinds with, the non-par products growing last year and also tailwinds in group term insurance. So all those are also sort of going away right now with the shape of the yield curve, etc. So I think that's going to be my sense. It'll probably underperform a little bit more and then do better. Once the entire thing is in the base. Yeah.
Got it. Good conversation, Madhukar. Appreciate you joining in, and thank you very much for running us through your views on the entire space. Very useful. Well, let's talk about markets, right? From a technical perspective, though, it's our special segment, Charting Trends. We have Sachinandan Utekar, Assistant Vice President, Technical Equity at Trade Bulls, who's joining us now. Thanks very much for joining us. Just a quick sort of, look at the Nifty itself. The views are pretty diverse. Not just from a technical perspective, but from a fundamental perspective as well. Many that we speak with, especially on the institutional side, believe that things are, looking, risk reward is not exactly all that favorable, although the downside may be limited. On technicals, also, I mean, we've seen slight pullback, but hasn't really amounted to very much. Do you have a firm conviction in terms of which way we are headed, and what's the sense? Go on, Nifty first.
Good morning, Prashant, and thank you for having me on the show. Clearly, when we look at some of the major trends in Nifty, the conviction still remains high. And, the exhibit which I've shared in front of you is the Nifty monthly chart for the last 10 years. Now, we've given a lot of emphasis on this particular indicator called ADX, and the way it is placed on its monthly scale is giving us that confidence that last 2 months, the kind of volatility that we have seen, the kind of corrective that we have seen so far in this particular current series, I think this entire correction should be absorbed, and probably we may see Nifty again trending on the higher side. So if you look at the exhibit in the third panel, where we have noted the indicator 2, the ADX has just crossed that 25 mark. Now, whenever this particular thing happens, it is a good conviction that has been seen in the following months, wherein the Nifty starts trending and continuing its higher top, higher bottom sequence. So if you look at the last 3 incidents as well, when we look at the history, a very similar setup was observed in July 2014 when the RSI was at around 77, displaying a very strong overbought kind of scenario. And during this particular month, we saw the ADX crossing that 25 mark. And post that, I think the Nifty surged from 7,700 towards 9,000 levels. So despite the RSI giving a overbought kind of a reading, wherein there are divergent views which are exhibited in the market because of the overbought condition, ADX is an indicator which purely guides us wherein the directional strength is still sustained, and whether it can be sustained in going in the immediate future. So here, we have seen a very similar phenomena in 2017 May. Again, a very overbought kind of condition when it comes to RSI, but the ADX had just given a breakout from the 25 mark. And post that, we saw that continuation of high top, high bottom sequence, and very similar exhibit in January 2021. So I think this is just a repeat of what we have seen so far in the last three instances when it comes to 10 years time scale. And even right now, we are of the opinion that before December 2023, we may see Nifty again scaling towards 20,600, 20,400 kind of a zone. And eventually, we may see the next year Nifty, scaling towards 21,400. So the setup is looking promising. We have already seen a good consolidation and a healthy correction, which should be bought in.
Got it, got it. So there's a good consolidation, healthy correction, and the the way forward is northwards, right? Got that. Which are the leaders of the market, of the next leg of the rally?
Good morning, Sonia. Sonia, I think one pocket that we are targeting is Nifty Realty, and if you look at this particular sector, again here, if you look at the ADX, the placement is very promising. We saw a very similar kind of a breakout from a rounding formation in the month of May 2017, wherein the ADX had just jumped above the 25 mark. The entire pattern unfolded a price target of around 50% on the higher side, and we have a very similar exhibit with the breakout that was recently exhibited at around 520 levels when it comes to Nifty Realty. Post that, we have seen one particular leg on the upside, but even right now the conviction is there that we could see this particular index itself scaling towards 750. Now, this is the pattern target of the rounding bottom formation that we have seen from September 2021. The accumulation was done well. We have seen a price surge and a consolidation now. So probably the next leg of the rally is evolving here, and we may see a good, sustainable move when it comes to Nifty Realty. So we are optimistic on this particular part.
Okay, all right. And if you're optimistic on the Realty Index, you'll have a couple of stocks from that pack itself that could look up, Sachi?
Well, Nigel, I think the focus still remains on DLF, and the weekly structure has been very clear. It has been respecting its 5-week exponential moving average well. Last week we saw a good healthy consolidation breakout. Now, if you look at the candlestick formation, it exhibits a rising 3 formation, which is a very rare continuation pattern when it comes to candlesticks. And if you look at the basic wave structure and wave counts, it purely looks like a breakout from a flag formation. So even from a trading perspective, we have been recommending, buying into DLF. The reward to risk opportunity is also good. We have a good pattern support to trail our stop losses. So even at this juncture, keeping a stop loss somewhere close to around 510, we may see a DLF scaling towards that 590-600 mark.
DLF scaling to that 590-600 mark. Okay, so those are interesting charts that you've put out: Nifty, Bank Nifty, Real Estate Index, and DLF. Sachiran, any other ideas you want to present? Positional ideas, which you think are good to go from here?
One particular stock that we have been tracking, and it has displayed a breakout today. A very similar structure to what we discussed in DLF is Bharti Airtel. Now, if you look at the last 3 weeks of consolidation, we saw a bullish pennant kind of structure there, and the stock was unable to surpass that 930, 940 cluster. So we have seen a good breakout in today's session, and that's why we have also recommended trading momentum to our clients through this particular counter. We are expecting that the broader picture still remains very robust. We may see this particular stock scaling towards 10,020, 10,040 kind of a zone. And right now, probably one can still add on to their longs with a stop loss at around 920.
Okay, I think for Bharti you meant 1,000, right? You said 10,000.
1,040, yes.
1,000.
You actually didn't mean 10,000.
All right, thanks a lot for that, Sachi. Appreciate your thoughts here on CNBC-TV18. Well, the market is looking good. 19,600 is holding. A lot of stocks in focus: Mazgaon Dock, Kalyan Jewelers, Escorts, Delivery. List is pretty endless. Phoenix Mills all up anywhere between 3 to 6%. So demand has come back. Let's slip into a quick break on that note. But when we come back, Manisha will be joining us to tell us what's happening in the world of commodities. Stay tuned. Welcome back. Let's get a quick handle on what's happening in the world of commodities. Manisha Gupta is here with us. Manisha, what are you tracking?
Thank you for that, Sonia. Well, we've been talking about the crude oil prices, but let's not lose sight of heating oil, natural gas, the crude products, that is, and those have been inching higher as well. So I'm talking about the natural gas prices, where in the US markets, we are now trading at around 8-month high. If you look at the last 1 week moves itself, we have seen the natural gas prices gain up by 14%. If you look at the European natural gas prices, those gained 15% overnight. And there are various concerns. The reason that you have seen such big surge come in for the energy prices there. Well, to begin with, we have seen the crude oil prices firm up from the low of nearly $85, $86 in the previous week to 88 plus kind of levels right now has been supportive for the natural gas prices. Add to that the fact that the Chevron Australia facility could be looking at labor resuming strike there. So that means the gas production there could decline, and that has been supportive. Israel also has taken a call to shut the Tamar gas facility because of the kind of war that's raging there, and the concerns that, that place could be hit is the reason they've shut that place out. Apart from that, there also is leak reported at around the Estonia gas pipeline. So that has led to lower pressure and lower gas flow into Europe. And that's the reason you've seen those prices gain up. Also, when you look at the US markets, and they have been the biggest exporters of gas in the last couple of years now, the production in US has continued to decline while the exports continue on a firmer note, is the reason you are looking at the US gas prices as well rising up. So whether it's about US, Europe or UK gas prices, we have seen a strong surge come in last week, 10 days. This is how the gas prices have behaved in this year. We started on a higher note at 3.6. That is a time when you were looking at winter demand concerns coming in. But somewhere in the month of April and May, we saw the prices decline by half to nearly $2 per MMBTU. In the last couple of weeks or so, we've seen prices gain up quite strongly. 3.3 is where we are trading right now. Markets do believe that with the winter demand coming in, we still have the hurricane season going on, and lower situation coming in from Russia to Europe as well are some of the factors that could keep the gas prices in favor.
All right. Thanks a lot for that, Manisha. Well, Escorts is one of the stocks that we're looking at this morning. The stock is up almost about 3% DAM Capital has raised their target price on Escorts substantially to 5,100 from 3,150 earlier, and this values the company at 30 times FY26 earnings. They talk about how there are significant synergies on the merger of Escorts and Kubota that will start to flow through. There's market share expansion through these synergies. There's strength of each brand. They are filling a lot of the product gaps as well, both in the domestic as well as in the export market. And there is margin expansion that they are expecting because of operational efficiencies and localization. They also talk about how exports are growing at a healthy pace because of some new products and capitalizing on Kubota's global network. But I reckon one of the other reasons why the stock is up is because of the news break that, we had a couple of months ago, which is not confirmed yet, but in all likelihood, Escorts will be selling its railway business. They are looking for buyers as well, and that deal perhaps could go through over the next 1 month or so, and hence the street is quite optimistic that they are selling a part of their non-core business and going to focus strictly on the farm equipment business. Hence, this is a big mover today. But Surbhi is with us. She has a couple of more stocks on her radar. Surbhi, what are you looking at?
So I'm looking at Genus Power. Now they won 2 orders worth 3,100 odd crores for appointment of advanced metering infrastructure service providers. Now this is basically to supply, install and commission close to 35 lakh smart prepaid meters. And the next one on my radar is Muscat Dock. They have signed a letter of intent with a European client. This is for construction of 6 firm and 4 optional units of multi-purpose hybrid power vessels. The price will be firmed once they sign the contract. So currently it's just the letter of intent and there is no pricing which has come out as of now.
Okay, thanks very much for that. But Surbhi,
let's take a we can take a quick break.
Commercial break here. I think we're up 100 points. 19,611 is where we're at. So after spending from the opening time at 9:15, I mean, we actually opened into the 19,605 level, which is the 40-day exponential moving average, and kind of toying around that level, spending the last 40-45 minutes around that level. There is a move higher which is coming. So you cross this, stay above this. You get visibility all the way till about 19,723 or so, which is the next important kind of pivot level. So let's hope it stays, the gains stay over the next many hours. So we'll take a quick commercial break here. We'll come back. My colleague Lata will get chatting with Gautam Dugar of Motilal Oswal Financial Services. They'll decode what to expect from the second quarter earnings season, which is right in front of us. Stay with us.
Well, the results season is going to well and properly hit from tomorrow when TCS announced its numbers, though today we have GM Breweries. So it's a very good time to look at the results season ahead. And we have perhaps someone who's best in the business, Gautam Dugar, the head of research institutional equities at Motilal Oswal Financial Securities. Gautam, thank you very much indeed for joining us. We have tried to put out as many takeaways from your huge, 130-page report, earnings preview. Well, one of the first things that intrigued me is that it's a damn good earnings growth. Nifty companies 21%, MOFSL universe 40%. But it looks like much of it is only because of the OMCs. If you remove the OMCs, it's a okay kind of earnings season. Is that right?
Lala, good morning. Thanks for having me. I won't call 20% growth is okay, because even if you look at my coverage without OMC, we're still talking about a 20% growth, right? So last quarter, we had 52% growth for our coverage. Without OMC, it was closer to 30%. Even last quarter, Nifty was 32%. Without OMC, it was 18%. And this quarter, as you rightly pointed out, we are penciling in a 21% earnings growth on Nifty. And without OMC, I think it is somewhere close to 15%. So very strong performance, Lata. It's coming on a very high base. If you look at Nifty's earnings over the last 3 years, they've compounded at 23% from FY20 to 23. So on that base, not only are we talking about a 20% growth for this particular quarter, we're also saying for a full year growth also, it is somewhere about 22%. So it will be very strong corporate earnings for FY24. Whichever way you slice and dice it, you look at X financials, X commodities, or X OMCs, numbers are looking very strong overall.
I just went by this X OMCs. You see 15%. It kind of took away the shine from the earlier big numbers that you threw at us. But you know what was most shining about your entire report? The earnings growth for MOFSL's mid-cap universe and small-cap universe. That's 104% increase. I mean, that's big. So do you think that we have to look for some very sparkling performance in mid and small caps now?
So, Lana, I will take that with a bit of a pinch of salt always, because there are a lot of base-related effects. There are a lot of commodities which are part of mid-caps and small caps. They're not part of Nifty companies. So you have to look at mid-cap, small-cap earnings always as a trailing 12 months average rather than get, worried about 1 or 2 quarters of a very strong performance, because there are many base effects which are at play right now. For example, if you look at cement sector has had a very horrible run for 7 quarters in a row. The last time cement sector in our coverage universe reported earnings growth was in September 2021. After that, there have been 7 consecutive quarters of earnings decline. And this quarter, we are seeing a 72% earnings growth on that extremely low base. Right? Similarly, OMCs, we are talking about some earnings doubling, tripling there on a YOY basis. But markets will look beyond that, right? Because things can change very rapidly in those very volatile and cyclical segments. But yes, if you just look at the categorization for this particular quarter, you're seeing a very high base, high growth in both mid-cap and small caps.
Okay. All right. Let me come to the overall picture itself. It looks like this is going to be more a margin and EBITDA-driven quarter. Sales is not what you're looking at.
So, Lada, look at it in this way. Overall sales growth is somewhere close to 6 to 9% in different set of aggregates. But when you look at sales growth X of commodities, it is about 13%, which essentially tells you that X of commodities, the sales growth is still very robust. Why is it depressed at 6%, including commodities? Is because of a very high base for commodities in the base quarter of September 2022. So that is why if you look at aggregate sales for Nifty and our coverage, it will give you a very different sort of a picture than what actual the underlying reality is. Yes, there is a broad-based margin expansion across the sectors. Auto, once again, the 4th consecutive quarter, where it will turn out to be the best performer in a variety of sectors that we cover. You are seeing good margin expansion as we discussed in cement. Same is the case for consumer. You're seeing margin expansion in metals, oil and gas. The only sectors where margins are expected to remain very flattish is healthcare and IT. at an aggregate basis, we are talking about a 350 basis point of a margin expansion for both our coverage as well as Nifty, excluding financials, right? So yes, this is a quarter where the margin expansion is very broad-based, which is why when you talk about a sales growth of 6-7% and EBITDA growth of somewhere about 18 to 20%, that is what is clearly evident, that the operating profit growth is clearly led by margin expansion, because volumes in many sectors like consumer are still very, very tepid. In some other sectors like cement and auto, they are healthy, but in consumer staples, you're still saying volume trending very low.
Oh, okay, so that would be a point of bother. Yeah, as you pointed out, autos 87% YOY rise in earnings, and cement are likely to be the standout sectors. Do you think we can be surprised even on the upside? Is there any sector that's going to really dazzle?
So
better than your expectation?
I think possibly auto can surprise again, because see, auto, there is a bit of a history. For FY18 to FY23, the earnings went nowhere. You know, the auto profits of FY18 in Nifty companies was 28,000 crores, and it was 28,000 crores again in FY23. Between FY23 and FY25, we are talking about profits doubling for auto sector from 28,000 crores to 57,000 crores. It went through 16 consecutive quarters of downgrades. And now last 3 quarters, we have seen consecutive upgrades. The December quarter, which is basically the January result season, April and July. And even in this preview, we marginally moved the numbers upwards for auto sector. So it is having a very good time right now, both from a volume as well as a margin perspective. And given the element of operating leverage which kicks in, you tend to get surprised on the upside. And when things were bad for them for 4 years, you were getting surprised on the downside. So auto is something which I will say one sector. Second is PSU banks. I mean, we have seen banking sector. When I said auto went through 5 years of a horrendous time, this is exactly the when banking profits went to 5 times in 5 years. And even that expanded base of 212,000 crores of profit which they delivered in FY23 for Nifty 11 BFSI companies, we're talking about a 27% growth in financial earnings, though it's not linear. Every quarter you will see moderation in banking growth now, right? So 1Q was the best, 2Q was slightly lesser, and 3Q and 4Q, the growth will moderate even further. But on aggregate for the full year FY24, you're still talking about 25-27% growth in financials, which is very strong.
Oh, yes, no taking away from that. But yeah, important that we've already seen the best quarters for banking and finance. Margins are likely to be under pressure in the results that will come in the second quarter. Now, let's discuss about prices, Gautam. You know, your Nifty EPS for the current year is almost 1,000 rupees, 986, which means we are 20 times. I mean, at the moment, it's very easy to divide. 20,000 Nifty, 1,000 rupees EPS. So we are at 20 times. Is that an attractive place to buy at all? You know, there are people who argue that in good times, we have traded for a goodish bit at 22 and 23. And so, you know, there is still reason to hold on.
So I think when you look at numbers now, you have to move forward on 12-month basis, right? When you talk about 986 is the EPS for March 24, which is just 6 months away, right? In another 3 months, markets will move on FY25, right? So where we are at around 1,130 rupees. So let's say one quarter down the line or 6 months down the line, if you're discounting FY25, I'm just giving you maths. I'm not making any predictions. Let's assume that this 1130 rupees of EPS stays intact. There's no downgrade. Or maybe it moves down to 1100. And the current PE, which we are talking about, 20 sustains. So if you just do the maths, 20 times 1100 gives you 22,000, which is the calculation for Nifty. Let's say the numbers look very optimistic and something happens globally or domestically, which pulls the market EPS down by 10%. From where we are today, 1130 to say 1050. If you're talking about 20 times on that number, you're still talking about 21,000. So if this earnings growth is very critical, if you look at last 3 years when Nifty compounded at 23%, Nifty gave you 27% compounding between the similar period. And I'm not just singling out Nifty. You look at NSE 500, which is almost represents 90% of the India's market cap. NSE 500 is an index earnings compounded at 28% for those 3 years. And the index gave you 31% compounding. So ultimately, end of the day, what matters over a period of time is corporate earnings. Everything else, macro rates, news flow, geopolitics, it falls by the wayside over a period of time, right? So corporate earnings, if they stay intact and this 986 and 1130 is delivered, you still have a decent, goodish bit of upside. As far as valuations are concerned, if you look at a 10-year average of Nifty PE, we are at about 20 times. If you want to take a very bearish picture and say, I want to look at 20 years of PE, then 20-year average is somewhere close to 17.5, 18 times. So if you compare versus 20-year average, we are 10% expensive. If you're comparing versus 10-year long period average, we are bang in line with the long period average on Nifty. The problem is in mid-cap and small-cap indices, which are very expensive. And especially mid-cap index is trading at about 15 to 17% premium to Nifty and its own long period average.
Can you leave us with one or two stocks where you see huge valuation gaps?
Sorry, can you come again? I missed.
Valuation gaps where, you think the market has not yet caught on to a good stock. Can you leave us with some stock ideas?
So my stock ideas are there all over in the model portfolio. But if you are talking about sector, I would think banking is looking very attractive from a valuation point of view. Sector has delivered excellent earnings, but the underlying market cap has not kept pace with it for a variety of reasons. Maybe the sector is overowned. Maybe people are concerned about the margins. Maybe people are concerned that the best of the cycle is already behind. But if you see my allocation in the model portfolio, our single largest overweight is still PSU banks and NBFCs. Then we have a significant overweight stance on consumer discretionary. Out of the 8 consumer stocks that we hold in the model portfolio, 7 are consumer discretionary, where conviction is very high on Titan, Indian Hotels, Zomato, and DMart. Right? And then we have been continuing with our large overweight stance on automobiles, where we have positions in Mahindra & Mahindra, Ashok Leyland, Bharat Forge, and Craftsman Automation. And this revision, we marginally increased the weight on pharma, made it overweight from neutral, where we added Cipla and Medanta. And yes, last but not the least, definitely industrials, which has done phenomenally well over the last 2 years. There, the big overweight continues with L&T, and incrementally, we've added Bharat Electronics. So that's the published model portfolio.
Okay, that's a great summary of all the stocks that you have recommended. Thank you very much, Gautam, for joining us. We will look forward to how the results season pans out starting tomorrow. TCS. Wrap up on Bazaar on that note. Chartbusters up next.